All right, let's dive into the latest quarterly report from Parkson Retail Asia. And, well, what we found tells the story of a company in a really tight spot. On the surface, things might not look too bad, but there is one number, kind of buried in this report, that tells a much, much more dramatic story. Let's see what the data shows us.
And there it is, the single most shocking number in the whole report, a drop of 84.4%. And we're not talking about some minor little line item here. This is the year-on-year plunge in Parkinson's profit before tax for the quarter. I mean, a drop this big, it's a massive red flag. And it's a figure that just begs for an explanation.
So that's the big mystery we're going to unpack today. What on earth caused such a massive free fall in profitability? A drop this big is almost never caused by just one thing. It's usually a perfect storm of factors all hitting the company's bottom line at once. So our job now is to follow the money and figure out exactly what happened. This table really puts that percentage into perspective with cold, hard numbers. And just look at the difference. In the third quarter of last year, Parkson brought in over 2.6 million Singapore dollars in profit. This year, that number just plummeted to 414,000. You don't have to be a financial analyst to see that as a huge decline. The key question now becomes, where did over $2 million in profits simply vanish? Okay, so the first logical place to look when profits disappear is always the top line. Did the money coming in the door just dry up? A huge drop in sales is usually the most straightforward reason for a collapse in profits. So let's see if Parkson's revenue numbers can solve this puzzle for us. And here's where the story gets a little more complicated. You see, revenue for the quarter was down, but only by 4.8%. And total merchandise sales, that's basically everything sold in their stores, was down by an even smaller 4%. Now, look, any drop in sales is not good news. But a 4 to 5% dip, that does not on its own explain an 84% profit evaporation. This tells us the problem isn't just about sales. Something else is going on under the hood. To really understand their business, you gotta look at how they make their money. This chart shows their sales mix. Over 82% comes from what they call concessionaires. That just means they take a commission from other brands selling inside their stores. The rest is from their own direct sales. What's really critical here is that the report says this mix has been very stable. So that tells us the issue isn't some fundamental shift in their business model. Something else is eating away at their earnings. So if a minor dip in revenue can't explain this massive profit collapse, there's really only one other place to look: the money going out the door, expenses. This is the other side of the profit equation, and as we're about to see, this is where the real story is hiding. And here we go. This is the smoking gun. If we look at the 9-month period, you can see two key expense categories just ballooning. Employee-related expenses are up over 8%, and operating lease expenses have jumped a full 10% year over year. These are not small increases. When your revenue is down a little bit, but your major costs are up significantly, your profit margin just gets squeezed from both sides. This is the main reason for that 84% drop. So why did these costs go up so much? Well, the report is actually very clear about it. That 8.1% rise in employee costs is partly because of an increase in the minimum wage. The company is also expanding its own private label business, which naturally comes with higher costs. And that 10% jump in lease expenses, that's tied directly to an expansion of the service tax on rentals in Malaysia, which is where most of their stores are. So what's clear is that these aren't just numbers on a page. These are real-world economic and policy changes that are directly hitting Parkson's bottom line. Okay, so we've pretty much figured out the quarterly profit problem. Slightly lower sales hit with much higher costs. But that's just a snapshot in time. To get the full picture, we need to zoom out and look at the company's overall financial health. And for that, we have to look at the balance sheet, which tells us a lot about its stability and its ability to handle tough times. Now, before we go any further, there's a key term from the report we need to understand: net current liabilities. In simple terms, this just means a company owes more money in the next 12 months than it has in cash or things it can quickly turn into cash. It can be a real sign of financial pressure, kind of like living paycheck to paycheck. And the report explicitly states that as of September 30th, Parkson was in this exact situation. So the next question is, why? A huge part of the answer is this number right here, 26.9 million Singapore dollars. So what is this? This is how much cash the company paid out to its shareholders in the form of dividends during this 9-month period. That is a significant chunk of cash heading out the door, and it has a direct and pretty immediate impact on the company's financial position. And here you can see the direct consequence of that decision. At the end of last year, Parkson was sitting on nearly $125 million in cash. 9 months later, that number has dropped to just over $86 million. The report itself links this drop in cash, driven by that dividend payment, to the company tipping over into that net current liability position. This shows it was a conscious choice to reward shareholders, but it was a choice that came at the cost of its short-term financial cushion.
So, we've got a handle on the past. We know why profits fell and how the balance sheet got weaker. Now, let's turn our attention to the future. What does the company itself see on the horizon? And maybe more importantly, what's their game plan to navigate all these challenges?
The company isn't trying to hide from the reality of the market. They've laid out the major headwinds they're facing, and it's a list that will be pretty familiar to anyone following the economy. You've got trade tensions, you've got inflation, the rising cost of living. All of this puts a huge squeeze on consumer wallets. And when people have less money to spend, department stores are often one of the first places they cut back. This pressure isn't going away anytime soon.
This quote, and it's pulled directly from their outlook, it perfectly captures the tightrope that Parkson is trying to walk. On one hand, they say they're being cautious, and that makes total sense given the economic headwinds and their weaker cash position. But in the very same breath, they say they're actively exploring opportunities to expand. This really shows a fundamental tension in their strategy. Do you play defense and protect what you have, or do you go on offense and try to grow?
And that really brings us to our final question. With profits under pressure, with costs rising, and with a shaky short-term financial position, what is the right path forward? Should Parkson be focused on conserving every single dollar of cash it has just to weather this storm? Or is this the moment to be bold, to invest in expansion, and try to capture market share while maybe some competitors are struggling? There is no easy answer here, and the path they choose will likely define their story for the next several years.